Today we're going to talk about the two time frames that would usually be the most popular for intraday active traders, usually the type of traders that are trading momentum or penny stocks. Those are the time frames that we're going to be touching on today. So here's the thing, when it comes to active intraday trading, momentum-based trading, penny stock trading, a lot of those movements that investors are looking to capitalize on can happen so quickly that generally they're using 1 minute and 5 minute charts to analyze in order to make sort of those decisions whether or not to buy or sell. So over the past years of trading and investing, it's been from my own experience that I've seen most active traders using 1 minute and 5 minute charts. Myself included, I typically trade on a 1 minute chart. So in this video, we're gonna break down looking at 1 minute charts, looking at 5 minute charts, showing you guys what traders are really looking for in those specific charts. But at the end of the day, it's all the same, and I'm gonna show you exactly what I mean coming up. So what we have here are two charts. On the left, we have a 1 day, 1 minute chart, and on the right, we have a 1 day, 5 minute chart. So you can clearly see the big difference between the two. And all it really is the way that the stock charts are presented to you based on the time frame at which you have inputted, okay? So if you look at the chart on the right, you see this yellow box. That yellow box is highlighting a 5 minute candle. That candle is actually the first candle to open up for the day on this day in which the stock market was trading. And on the left, we have the 1 minute chart. Now that 1 minute chart with the yellow box is highlighting 5 1 minute candles. So your difference between the two charts, as I've highlighted in those boxes, are just that. You can see the candle on the right, just one candle, right? And then the one on the left has 5 candles. So the chart on the right is really just showing you all the trading action of these 5 1 minute candles, but just in one candle. So it doesn't actually change the price that the stock has gone to. It doesn't change the high or the low in which the price of the stock got to. The only thing it actually does is change the way that it's being represented for you, or it's changing the way that it appears. And again, the appearance that you're seeing is only based on the inputs that you give the computer. So if we tell the computer, hey, I want to look at this on a 20-minute time frame, then of course it's going to change it to how it should appear to encompass a 20-minute time frame, okay? But the price at which the stock reaches is always going to be the same. And that's what I was trying to tell you earlier on in this video, that it's all the same at the end of the day coming up, and that's this, that no matter a 1 minute time frame, a 5 minute time frame, a 20-minute time frame, a 365-day time frame, the price of the stock is always going to go to whatever price it wants, and every time frame that you look at will always show you the price that the stock went to, okay? So with that being said, now let's jump into what traders are actually looking for on, say, 1 minute time frames versus 5 minute time frames, and why traders would particularly pick maybe a 5 minute time frame over a 1 minute time frame. So I will say the reason a trader would pick a 5 minute time frame over a 1 minute time frame is usually because the 5 minute time frame's a little less busy. It's less confusing. There's not as much going on, so it can make a trader feel more comfortable, give them more confidence in maybe taking sort of a trade and or a position. Whereas if you look at the 1 minute chart, there's way more going on. There's way more candles. It could look more confusing. It could cause a trader to get faked out. And that is really the big difference that if you talk to any trader, they would most likely tell you. Now, I will also tell you this. Again, it really doesn't matter if it's a 1 minute time frame or a 5 minute time frame because the prices still go to the exact same point. So if you're someone who trades on a high-low basis, then it wouldn't really actually matter the time frame you pick because no matter the time frame, the price is always going to be going to what you believe to be a high or you believe to be a low. The only thing that time frame changing or trading based off of a particular time frame will do for you is change the way that each candle is presented to you, which therefore can change over chart patterns. So time frame for me and for many, the only thing it really does is change over the way that the candle appears, which could then make you believe that you are seeing some sort of pattern that you otherwise would not have seen on a lower time frame or a higher time frame, okay? Now what I'd like to do is get into sort of the nitty gritty. We're going to zoom in on these charts. We're going to take a look at why really traders would choose a 1 minute over a 5 minute, or why they would choose a 5 minute over a 1 minute, and the key important things to look for in those charts for those price breaks. So what we have now is a chart of AMD. I figured I'd pull this one up because I could use this example and explain it a little bit better. See, for me, trading on a 1 minute time frame allows me to see more trading activity on a more minuscule time frame, so I'm getting more data to essentially go off of. At least that's what I think. And the chart on the right, the 5 minute, it gives you essentially less data to go off of. Now, many will say that trading the time frame of a 5 minute chart can give you more accurate entries or more accurate trades because you maybe sit a little bit more patient and you're waiting for it to develop, whereas on a 1 minute chart, there's so many candles that are moving. One of those candles might convince you that something's about to happen, and then it doesn't happen, and that's kind of the confusion part, right? But let me explain. The reason I trade 1 minute charts, maybe over 5 minute charts, most of the time, is because a 1 minute chart gives me more detail. So sometimes I could find myself getting an entry before that of someone that's trading off a 5 minute chart. And as you guys know, if you're going to be doing any sort of trading and or investing, the person that makes the most money in the game is the person who buys first and then is correct, right? That's how it works. So on a 1 minute chart, what I've come to find is you get more detail and you'll actually be able to tell when something's going to happen quicker than you would find out if you're looking at a 5 minute chart. Now, for those of you that trade all the time, you might say that this is completely wrong, but I would love to hear your comments or thoughts in the comments section below. So feel free to comment on this video what your experience has been using 5 minute charts in comparison to 1 minute charts, and that can help anybody viewing this channel read those comments and then learn from your past experiences and or mistakes. So I do appreciate you guys if you could share those experiences down below. If we look at the chart on the left, the 1 minute chart, let's say that I wanted to catch this bearish move down, okay? Well, for me, something that would tell me that it's probably getting bearish, in the immediate time frame. If I'm someone who looks at 1 minute charts and 5 minute charts, and I'm just looking for the way candles move and break certain prices rather than maybe trading trend, okay? I would say to myself that the price on this here, AMD, is getting bearish, right? In this move, it's getting bearish when it starts to break below that green candle. That candle right there, when the price comes down and then starts to break through that green body candle low, the body of that candle, I would say that's starting to get a little weak. Whereas somebody who trades a 5 minute chart, they would maybe pick the low of that candle, right? They would say, when we get below the low of 78.50, then we're starting to get weakness. So they would essentially be waiting for the stock to break down that candle low, whereas we would have already seen weakness as it breaks below that 1 minute green candle there. That's a perfect example of something that I could totally see myself visualizing in real time, saying, we're going below that green candle, we're getting weak, all short. Whereas I could totally see someone who's trading a 5 minute chart go, well, I might like to see it break the previous 5 candle minute low, right? That's an example I could totally see happening. Now, there might be other traders out there that would say, when this 5 minute candle breaks below this candle low, I'll go short. But I can tell you from past experience, most traders wait for more confirmation than for less confirmation, right? So in most cases, it would probably be a trader saying, once we actually successfully break this support low, then I'll go short, which then means they're actually going to get caught in most of the selling pressure. So rather than getting a fill right here, and this also depends on brokers, you're probably going to get filled somewhere down there. So whereas we're taking the short up here before the main price break of right there, we're going to get a better fill in that location, whereas if everybody tries to sell at the same time. So this is a very important lesson that I didn't actually mean to go over in this video, but take it very seriously. Look down at the volume here. Ready? Bang. Look at that volume. That volume happens on that candle. That means a bunch of people were all selling at once, right? Okay. Whereas if you look at the previous candle on the 1 minute chart, there's not as much selling. So there's not as much activity. Okay. Well, if you were able to get on that 1 minute candle here before the price break of 78.50, where all the volume happens, you're more likely to get a better fill. You're not joining the tsunami wave of sellers. So the best example I could say is, imagine this. I want to sell this notepad or this tool right here. Boom. I want to sell this tool. Okay. and I got a price of it for 5,000 bucks. If everybody all starts coming to me at the same time trying to buy it for $5,000, there's a strong chance that I could just raise the price and keep getting buyers, right? If everybody wants it that bad, I could probably sell this for much higher than 5,000. It's the same example as when you look at this candle here, right? When everybody's trying to get in on the same candle, the market makers and everybody, they could just keep dropping the price and giving you fills a little bit lower because there's so much demand at that specific moment in time. The likelihood that you're going to get the best fill or the best price possible, it's just not going to happen because there's just way too much demand that's trying to sell the stock at that time. You might run into the situation where you wanted to get filled at 78.50 or maybe 78.45, but all of a sudden you get 200,000 shares of selling volume and you might up getting the fill down here at 78.40. So now you're getting 5 cents less than what you wanted because you had to wait for the extra confirmation of it breaking that 78.50, which you identified as support. This is the way the game goes. If there's a support system and we go below it, everybody panic sells and freaks out, right? You want to identify that level is most likely going to get broke before it breaks so that you can take price before it. And then as everybody stops out, you know, if this was a short position, you'd be selling into them and so on. So that's the point I'm trying to make here, is that 1 minute charts can actually signal you of a move that's going to happen quicker than a 5 minute chart might. But there will be many times where you might think the 1 minute chart is giving you a signal that you can be actionable on sooner than a 5 minute chart, and then it actually be inaccurate. So again, this is something that you're going to have to play with and you're going to have to practice with. But the main difference here is that 1 minute charts can signal you of moves that are going to happen sooner than a 5 minute chart can, but a 5 minute chart might give you more accuracy in the long run, ladies and gentlemen. Now, before we end this video, there's one more important thing that I would like to touch on, and that is this. If I may, I'm going to change over the time frame on the right screen. Remember that when I told you it's all about perception? See, if we change the time frame, and I got to go back to the SPY actually. I'm going to go back here because the example will work a little bit better here. So we're going to go back to the SPY, okay? So if we have the 5 minute chart here and we have this chart over here, the 1 minute chart, you can see that it's a inverse head and shoulders pattern, okay? So it doesn't matter if you're looking at the 1 minute or the 5 minute, but that pattern is still the same. But if we were to increase the time frame, come on computer, there you go, buddy. If we increase the time frame to say a 1 day, 1 hour chart, that's 64 minutes, there you go. A 1 day, 1 hour chart, what ended up happening? The pattern is no longer the same. We no longer have an inverse head and shoulders pattern that appears to have happened on this day. It just shows that we have a red candle, a green candle, and then bang, market tanks. It never actually shows you, hey, the market dipped down, then we fight to come back, then we dip down, then we fight to come back, and we perform a pattern that's actually supposed to be bullish. At least that's what Google tells you. Go type in Google inverse head and shoulders pattern, and they're going to tell you that you were supposed to buy that breakout. If you look at an inverse head and shoulders pattern on Google, or you go to Investopedia, or pretty much any sort of mainstream educational finance site, the typical go-to thing that they would have taught you here is that the inverse head and shoulder pattern, you're supposed to actually buy as it breaks over these highs. So as the market broke over those highs, you're supposed to get long here and look for this to keep going, okay? But I will tell you right now, and I got to just do this quickly for the video because it's just going to be great. If I could just, oh, it doesn't look like TD Ameritrade's working anymore, so I probably can't do what I wanted to do, but that's okay. So we'll end it there. I hope you guys liked the video. I hope you learned something new from this. As always, make sure to hit the thumbs up button so that way we trick the YouTube algorithm into thinking this is the world's best video so that we can actually educate traders on good content. I appreciate your guys' help and I appreciate your support for tuning into Boiler Room Trading. That being said, I'll see you guys in the next one. Take care.